Okay, I'm going to get into some specific examples and show you how options react based on the underlying changes of the ETF that we're looking at, in this case the QQQs. But before I do that, I just want to point out one additional thing that affects the price of an option. The delta, as I mentioned, affects the price of an option based on the movement of the ETF that we're studying. I mentioned that the December 11, the 58 strike price calls here have a delta of 0.29, which means that if the ETF rises by $1, this option, currently selling for about 30 to 31 cents, would rise 29 cents based on a delta of 0.29. So for every dollar rise in the ETF, the option would rise 29 cents because of its delta. The second thing that affects the value of an option to a much greater degree is something called vega, and that's the volatility of that particular option. Now, the volatility, the vega, is listed here along with the other Greeks, as they're called, in the option market. And the volatility is always quite a bit larger when surrounding the at-the-money calls and puts. So in this case, the volatility of the at-the-money calls is 0.03. The at-the-money volatility of the puts is 0.03 as well. As you get out of the money, the vega becomes much smaller, and as you go deep in the money, the vega gets smaller as well. And what volatility does is measure it's a measurement of the potential range in which this security will trade until expiration. So with 7 days left to expiration, in this particular example, with a vega of 0.03, the market is saying that the potential for it to move in wide swings is fairly low. When volatility increases, you will see extremely wide bars on the underlying instrument. In other words, the movement of the stock or ETF that you're watching will either shoot up dramatically or decline dramatically in a very large percentage move. That gives us an idea that volatility could be increasing over a short period of time, and there's a lot of trading opportunities that are available to us if that should happen. I'll give you in later examples some clues of how to look at volatility, how to determine whether or not volatility will be persistent through the next several trading sessions, and how you can capture profit opportunities from volatility. But it is an extremely important factor. When volatility is low, things tend to move very slowly through the market, generally higher. So the broad indexes like the Qs or the diamonds or the which is the ETF for the Dow Industrial Average, or the SPY for the S&P 500, all of those financial instruments tend to move up and up slowly. When volatility increases, normally what happens is there's a drop in the market shortly thereafter. Volatility is an important pricing mechanism, and it's also an important Greek to keep track of, because it presents a lot of profitable opportunities. All right, let's do one other thing before we move on, and that is take a look at volume and open interest. I picked the Qs specifically because they are a highly active set of options in the market. There's quite a bit of volume in each of these in the Q series, and you can see that the current volume, the column to your left, is all of the volume in the calls today. You can see that the December 60 strike price traded 1,795 contracts. The 59 strike price had 13,733 contracts traded, and those are just today. They also somewhat represent a bell curve. You can see that those deep in the money options rarely traded at all, didn't trade at all today until you got down to the 50s. The 50s started trading at approximately 80 contracts. Well, why would that be? Well, let's go back to why didn't any of these other in the money, in other words, why didn't any of these other in the money options trade? Well, if we go back and take a look at the delta again, you'll notice that almost all of the deltas from the 50 onward have a delta of 1. So if you were interested in participating in a dollar for dollar move with the underlying stock or ETF, why would you pay more than the strike price at 50 for $7? Why would you buy something with a strike price of $40, for example, when it would give you the exact same delta? It's not there's no advantage to buying more delta than you need. In this case, at the 50 level, probably early this morning when it started trading, it was maybe just under 1.00. In that case, they wanted the most bang for their buck. They wanted to get as much delta as they possibly could by buying that option. Buying the 49 strike price option is no advantage. It's more expensive, and it still gives you a 1 delta rating, so that if the market should rise by $1, they would also gain $1 as well. So the percentage gain is better for the 50s. Or is this the percentage gain is better for the 50s, but the same dollar amount gained through delta for the 49s and the 48s and the 47 and the 46 and so forth. So there's no reason why you would buy a deeper in the money call in this case. So if we go back to volume for a second, you can see that why that would be the chosen option if you really wanted to buy real value and you wanted to participate penny for penny, dime for dime, dollar for dollar move in the Qs today. You would buy the least expensive one that you could possibly find with a delta of 1, which specifically matches the movement in this underlying instrument. So you've got a somewhat of a bell curve. Most of the people who trade options trade around the middle. They trade around these at the money options, in this case the 57 and the 58 strike price options. The same is generally true for puts. However, since puts are generally considered to be a protection and sometimes a speculation instrument, then you don't quite get the same type of curve, and you don't get quite the same number of contracts traded right around the at the money prices. They tend to be a little bit lower than at the money because people are either buying protection or they think there's going to be a very quick move down in the market and they want to capitalize on the increased volatility. Increasing volatility will raise the price of an option above its normal value, its lower volatility value, and generally pumps up the price of an option, in which causes the person who purchased it out of the money a profit. And I'll show you exactly how volatility increases the price of an options without in a future video. And here's another example of why generally put options are considered either protection or speculation if the market should crash. You can see that the open interest, that's the number of contracts that are still open but not closed out for this option chain for December with 7 days remaining until expiration, this one has 219,000 open interest. People are speculating that the market will crash. If so, that 2-cent option or whatever they bought it for will rise dramatically. So you get a lot of out-of-the-money options that people purchase for protection. Not so much so in on the call side, as you can see, the open interest is relatively much lighter at the higher strike prices for call options. People don't use calls as protection when they buy them. Generally what they want to do is buy. They want to buy delta. They want to buy the intrinsic value, like the 50 calls, in order to take advantage of the low volatility and the rising market itself. Let's look at some specific examples of how prices will change the price of options. Let's go over to our charts here for a second. We're going to change this chart over to the Qs, and then we're going to pick a time period in which there was some changes in the market so that we can measure the changes in the underlying options. For example, we have a low here going back to June 16th. A low of approximately the close at 53.86. So let's go over to our trade tab, and then we'll go over to our analyze tab, and the Thinkorswim platform gives us actually the ability to go back in time and look and see how options behaved when price changes over time. So let's go back here again. We can see that the June 16th closing was at 53.86. Using perfect hindsight, we know that the market rose. So let's go over to our Analyze tab. We're going to go back in time to June 16th. And at that time, at June 16th, there was only 1 day left on the June option. So let's go over to the July option. And let's say that we go ahead and we purchase, let's see, what we want to do is we want to take a look at delta, because I like to buy delta. And with a strike price, a close at 54.08 on June 16th. What I want to do is I want to buy some delta. I like to buy 88 or 90 delta. So I'll go with the 48, and I'll buy, let's just buy one contract here of the Qs for July expiration at $6.23.5, which is the midpoint between the $6.12 bid price and the $6.35 asking price. Many times when you're putting in an offer to buy an option contract, you can split that middle, and sometimes you'll get it, sometimes you won't, but you can try. And so we start out now knowing that the market will be rising over the next few days. So all we have to do now is advance the time to see exactly how we fared. Now the delta is 0.91. So for every dollar that the Qs rise, we should gain 91 cents in profit. Let's advance the time 1 day at a time. Okay, on the 17th, the Qs were down just a little bit, 16 cents. So we lost $23 so far on our one option. On the 18th, it was a weekend. The 19th is a Sunday. So we have to advance to the 20th. At the 20th, the index, the ETF, rose 28 cents, and we are at a loss of $7. On the 21st, the index rose $1.16, and we now have a $99.50 profit with a single contract. So remember that, and also let's take a look, our delta now, we have the 48 contract, our delta now is at $1. So we rose $1.16, and we gained about $1.06. It's not exactly perfect, but it's about $1.06, because remember the previous day we were down $7. We rose about $1.06 in our option price, with a delta of 100. It's now trading for $7.11 to $7.35, rising approximately $1 from our $6.23.5 price that we paid for it. And one thing that you can use to determine, of course, how much profit you get, like I said, is that you're taking the delta times the change in price, in this case it's $1.16. But remember that for a single contract, each contract is the ability to gives you the right, but not the obligation, to purchase 100 shares for each single contract that you purchase. So in order to figure out why you have a $99 profit here, you take the one contract times the delta times the number of shares that you are able to purchase with that single contract, which is 100, and it gives you a $100 profit. And that's why the day before, which was on the 18th, you had a $23 loss. You had a $7 loss. I'm sorry, the $7 loss on the 20th, and now you have a $99 profit. All right, let's continue. On the 22nd, the index lost 39 cents. Now you have an open profit of just $60 because the market declined. On the 23rd, we went up 50 cents. We gained about $23. On the 24th, we're down 96 cents. We lost almost $1, but we only lost about $70 in profit. Now there could be a couple of different reasons for that. Number one is volatility that I talked about before. When volatility rises, it generally keeps option prices relatively high across the board, both puts and calls. So when the market dropped and went against us, because it did so in a fairly large move at 1.73%, it kept all option prices a little bit higher because of the Vega. That's why we didn't lose exactly $100. The 25th is a non-trading day. The 26th. The 27th, we were up 86 cents. And now we have a profit up above 100 at $111. On the 28th, we rose another 82 cents. Now we have a profit of $191. On the 29th, we rose 23 cents. We have a profit on the 29th now of $213. On the 30th, we rose another 75 cents. So now we have a profit of $276. On July 1st, we rose another 86 cents. And we have another profit of about $100. On the 2nd, we rose, sorry, that's a non-trading day. Sunday is a non-trading day. Monday, July 4th is a non-trading day. July 5th, the market opened again. We're up 29 cents. And we have a little bit more profit. On the 6th, we're up 19 cents. We have even more profit. On the 7th, we're up 80 cents. And now we have $509 in profit. And if we take a look at our option chain, you can see that the July 48 call is now at $11.43 asking price. So it's risen close to $5 since we purchased it on June 16th. Let's take a look at our chart, and you can see that it looks like the market was starting to stall out on July 7th right in here with this little bit of a gap up open. At that point, with great hindsight, we should probably sell this call for a profit and wait to take advantage of our next opportunity, making a $509 profit in a couple of weeks. Okay, it's very important to get out at a time in which you have a profit. Let's take a look and see what happens to the index after July 7th. And you can see that the market starts to drop. If we held on to the 11th, remember we have a $509 profit on the 7th. If we held on to the 11th, we'd only have a $390 profit. If we held on a couple more days to the 14th, we would have a $318 profit. So our profits would begin to sink. It's possible to hold on for a while. We could go to the 20th, and we'd have a $361 profit. It's still below the $500 profit that we got on the 7th. Of course, that's with great hindsight, because the market actually pulled back a little bit and then started to rally again before dropping off dramatically. It wouldn't take long before our profit, and we'd have a very, very much smaller profit. But generally, any time that you, we'll go into chart reading and technical analysis in future series here, but once you have a dramatic run-up in just about any kind of stock, it's always a good idea to take profits. The reason for it is just by taking a look at this current chart. I mean, basically, the market has gone up and down without really very much movement. I mean, we've basically been in a sideways consolidation period for the entire year. This goes back to December, and we're in December again, and there's been really very little movement in the market. But within this consolidation range, there were rallies and declines that could have been taken advantage of and profited from. Okay, so that's an example of how you can profit from purchasing options. Like I said, I prefer to buy delta between 88 and 95. 88 on the low end and 95 at the high end, but 88 or 90 would be absolutely ideal. And if I was going long the market, I would want to buy an in-the-money call. If I was going short the market, I would want to buy an in-the-money put at approximately the same delta. In the next video, we're going to be talking about selling calls and selling puts to profit from writing these instruments rather than buying them.